Let me ask you something. What if the moment the Federal Reserve makes its most painful decision, raising interest rates, is actually the single best buying opportunity of the decade? Not in stocks, not in crypto, in bonds. 20-year Treasury bonds, to be precise. My name is Roldan Ferrer, and I have spent the last 25 years working in financial markets, trading desks in New York, advising institutional investors across 3 continents, navigating the dot-com crash, the 2008 collapse, and every rate cycle in between. And I can tell you this with absolute confidence. Most retail investors completely misunderstand bonds. And that misunderstanding, it costs them a fortune. Today, I'm going to walk you through a trade, a real executable strategy that could be one of the most compelling setups I've seen in years. We're talking about what happens when the Fed raises rates, why that's actually the moment you want to step in and buy long-duration bonds, and exactly when you sell them to lock in your gains. Stay with me. This one's worth your full attention. Before we get into the strategy, I need to make sure we're speaking the same language, because the #1 mistake I see, even from people who consider themselves financially literate, is a fundamental confusion about how bond prices work. Here is the iron law of bond markets. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. They move in opposite directions, always. This is not a theory, it's math. Think of it this way. Imagine you buy a bond today that pays you 4% per year. Now, the Federal Reserve raises rates, and new bonds being issued are paying 6%. Suddenly, your 4% bond looks a lot less attractive. Nobody wants to pay full price for a bond that earns less than what's available in the open market. So the price of your existing bond falls until its yield becomes competitive again.
Now here's where it gets interesting. And this is where most people miss the opportunity entirely. The longer the maturity of the bond, the more sensitive its price is to changes in interest rates. A 2-year Treasury bond barely flinches when rates move. But a 20-year Treasury bond? That thing moves dramatically. We call this sensitivity duration. And for a 20-year bond, the duration effect is enormous. A 1% move in interest rates can translate to a double-digit percentage change in the price of that bond. So, when the Fed is in a hiking cycle, raising rates aggressively, long-duration bonds get absolutely crushed. Prices fall hard, which means yields soar. And that right there is your entry point. Let me give you the macro context here, because understanding the Federal Reserve's behavior is essential to timing this trade correctly. The Fed operates in cycles. It raises rates when inflation is running hot and the economy is overheating. Their mandate is price stability, so when prices are rising too fast, they act. They hike aggressively. They hold rates high for a period. And then, eventually, when inflation cools, when the economy starts to soften, when unemployment ticks up, they pivot. They start cutting. This cycle has repeated itself throughout history. We saw it in the early 1980s under Paul Volcker. We saw it in 2000, in 2007, and most recently in 2022 and 2023, when the Fed executed the most aggressive rate hiking campaign in 40 years. Rates went from near zero to over 5% in roughly 18 months. Here's what the data shows us every single time. when the Fed is near the peak of a hiking cycle, when rates are high and the market begins to price in the eventual pivot, long-duration bonds start to look extraordinarily cheap. The yields on 20-year Treasuries have already been driven up dramatically by the hiking cycle. The price you pay for those bonds is depressed, and you are essentially locking in high yields while positioning yourself for significant capital appreciation the moment the Fed begins to cut.
In my 25 years, I have watched investors wait for certainty before buying. They want to wait until the Fed actually cuts before they buy bonds. By then, the trade is over. The market moves in anticipation, not confirmation. The opportunity is in buying when the pain is at its maximum, when everyone else is running away. All right, let's talk specifics. What does this trade actually look like? Saturate your Treasury bonds near the peak of a Federal Reserve rate hiking cycle, and you hold them until the Fed begins its cutting cycle and rates come down meaningfully. At that point, you sell into the bond rally and capture both the coupon income you've collected along the way and the capital appreciation from the price increase. Let me walk you through the mechanics with a concrete example. 5%. 5% annual income stream, that alone is attractive. But here's the kicker. If the Fed then cuts rates by, say, 200 basis points, 2 full percentage points, over the following 2 years, what happens to the price of that 20-year bond you bought? Given the duration of a 20-year bond, roughly 12 to 14 years of modified duration, a 2% decline in yields could translate to a price appreciation of somewhere in the range of 24% to 28%. Add that to the coupon payments you've been collecting, and you're looking at a total return that is difficult to achieve in almost any other fixed income instrument. Now, how do you actually execute this trade? You have several options. The most direct approach is buying individual Treasury bonds through Treasury Direct or through a brokerage. A second option, and the one most accessible to retail investors, is purchasing an ETF that tracks long-duration treasuries. There are several well-known products in the market that specifically track the 20-year plus treasury segment. These give you liquidity, transparency, and daily pricing. A third option, for more sophisticated investors, involves treasury futures or options, but I want to be clear, those instruments carry leverage and complexity that are not appropriate for everyone. For the vast majority of people watching this, either direct Treasury bonds or a long-duration Treasury ETF is the cleanest way to express this trade. One critical point on timing: you are not trying to perfectly call the top of the rate cycle. That is impossible. What you are doing is identifying a window, a zone, where rates are historically elevated relative to the economic cycle, where the Fed's forward guidance suggests the hiking campaign is near its end, and where the risk-reward is asymmetrically in your favor. You might enter a little early. That's fine. If rates go up another 50 basis points after you buy, your position will be down temporarily, but your thesis remains intact, and the eventual trade-off in your favor will still materialize. Now, let's talk about the other half of this trade, because knowing when to buy is only half the battle. Knowing when to sell is equally important. The exit trigger for this strategy is the Fed's cutting cycle. Specifically, you want to be watching for several converging signals. The Fed explicitly pausing its hikes,
inflation data showing a clear and sustained downtrend, GDP growth softening, and ideally some weakening in the labor market. When those conditions align, the cutting cycle is imminent or already underway, and that is when bond prices start moving sharply higher. You do not need to sell at the absolute bottom of the rate cycle. In fact, I would argue against trying to do that. What you want is to sell when rates have come down substantially from their peak, when you've captured the majority of the price appreciation. 5%, you've already captured most of the gain. Holding for the last 50 basis points while taking on risk of a reversal is usually not worth it. In terms of position management, if you entered the trade in phases, buying in tranches as yields rose, you can exit in phases as well. Take a third of your position off early in the cutting cycle, another third when the cutting cycle is in full swing, and the final third when rates approach their cyclical lows. This approach reduces the impact of mistiming the exit and allows you to average out effectively. One more consideration: taxes.
In most jurisdictions, capital gains on bonds held for more than a year are taxed at the long-term rate, which is more favorable than short-term rates. If you are near the one-year mark, it may be worth holding slightly longer to qualify for that treatment. This is not investment advice. Please consult a qualified tax advisor, but it is a factor worth considering in your overall return calculation. I want to be completely transparent with you, because this is what separates serious financial commentary from the hype you find elsewhere. This trade has real risks. You need to understand them. Risk number 1. The Fed doesn't cut when you expect them to. Inflation proves stickier than anticipated, the economy remains resilient, and rates stay elevated for longer than the market priced in. This scenario means your bonds continue to underperform, and your capital is tied up earning coupon income, while other opportunities may arise. This is manageable because you are still earning income, but it requires patience and a strong conviction in your original thesis. Risk number 2, a genuine, higher for longer structural shift. This is the more serious version of risk 1. There are credible arguments that the post-2008 era of ultra-low rates was the anomaly, and that rates in the 4–5% range may be the new normal for a prolonged period. If that's the case, the magnitude of any eventual rate cuts go smaller than historical cycles, and the capital appreciation on your bonds will be commensurately reduced. This is why position sizing matters enormously. This should not be your only trade. Risk number 3, credit risk, U.S. Treasuries. If you're tempted to chase higher yields in corporate bonds or emerging market debt to enhance returns, understand that you are adding a layer of credit risk that changes the nature of the trade entirely. In a rate-cutting environment that accompanies a recession, corporate bonds can get hit by widening credit spreads even as Treasury yields fall. Stick to Treasuries for the cleanest expression of this rate cycle thesis. Here's what I want you to take away from today.
Financial markets reward people who understand structure, who understand cycles, who understand the relationship between monetary policy and asset prices. The retail investor who dismisses bonds as boring or complicated is leaving a significant, predictable, repeatable opportunity on the table. The Fed rate cycle is one of the most reliable macro frameworks we have. Rates go up, they stay high. The economy eventually cools. The Fed cuts, bonds rally. This is not a secret. It is in every economics textbook ever written. The challenge is having the conviction to act on it while it is uncomfortable, while everyone around you is saying rates are going higher, while your bond position is temporarily underwater, while the news cycle is screaming about inflation and economic chaos. That is the moment the trade is most attractive, and that is the moment most people do nothing. I've been in this business for 25 years. I've seen this cycle play out multiple times, and every single time,
The investors who understood the mechanics had the discipline to enter when the pain was highest and had the patience to hold through volatility. Those investors were rewarded. Do your own research. Consult a qualified financial advisor before making any investment decisions. But make sure that research includes a serious look at what long-duration bonds do in a rate-cutting cycle. Because if the Fed is near the end of a hiking cycle right now, the clock on this opportunity may already be ticking. I'm Roldan Ferrer. If this was useful, subscribe, and I'll see you in the next one.